Welcome back. The next two lectures are going to focus on implementation. We talked about the financial markets, about financial instruments, we talk about retirement, we talk about asset allocation. And when you left the asset allocation last time was at a high level. But before we get into the detail, again, you're going to keep hearing this from me, savings and investment are not the same, trading and investing are not the same. So we really got to look at what your purpose is. And when we look at trading, it can be seconds to months. Investing is a longer term view. Now, why is a longer term view important is because you have a longer period to benefit from it. So these short term volatility, which is what sometimes traders benefit from, if you're looking long term, you get that benefit over time. When we look at any asset class, there's a trade-off between risk and reward. And that the asset class simply refers to a distinct type of investment or to a group of assets that share common characteristics as we talked about. There's equities, there's bonds, which are fixed income. We got treasury bills, which are short-term, 90-day instruments. We got cash. And then we have the alternative investments, real estate, commodities, oil and gas, etc. But each one has its own unique risk and return characteristics that we've already seen. I think what I want to do now is break down equities a little further. In our previous section, we discussed the broad asset classes of equities and bonds. I'd like to break the equities down further. One is you can break them down between U.S.-based companies versus foreign-based companies. Now remember, a lot of U.S. companies do business overseas, and a lot of the revenue comes from overseas. Foreign-based companies often do business here in the U.S. So there's these multinationals that really are benefiting from all the different markets. But when you move into the medium and to the smaller, you have those that are more focused on that country. And different countries, as you've seen, have different growth rates. They have different rates of return. So you want to look at them and say, again, this is back to your diversification. If you want to benefit from certain things, you've got to be in these different markets. You don't want to put all your eggs in one basket. The next thing to look at is the size of the company, the market capitalization. And that's the number of shares outstanding times the purchase price, the sales price of the stock. Large is over $1 billion. Medium is $1 billion to $5 billion, and small is less than $1 billion. So what we have is you take these equities and you got to break them down into domestic and foreign, and then based on size. Why is that important? Well, we look at this slide, and what you can see, this shows you returns by detailed asset class from 1999 to 2013, and then over the 20 years, the best, the average, and the worst. Now, as you can see, sometimes small stocks, 1, 2, 3, 4, they were on the top. They produced the best return. But on other times, you saw them down here being the worst. Okay? So when we look at small caps, if you were in it this year, you would have done really well. But if you were in it down here and you lost 36%, there's a big difference. So you want to balance between these. Okay? And over time, what we see is mid-cap stocks perform the best at 14 on average. But look at their best and their worst range from 40 plus to minus 42. As we work our way down to large, they're 12%, which is less, but look at the difference in variation. Okay? And that's what you start to see is there's difference. So over time, this will tell you what the different categories are performing on a long-term basis, but on a time basis, you never know which one's going to be up. It depends on various characteristics of the economy and the market. So you can see that you need to be diversified to take advantage of some of these, and some of them actually move inverse to each other. Okay? We see that the relationship between long bonds and foreign stocks in that year were related. Here, foreign stocks were on top, long bonds were on the bottom. So we do see that. Now, this next one is tough to see, but this actually shows you the same thing through 2014. Same thing is present there. Let's keep going with equities. There's also different styles of investment, and these styles are really in three categories. One is what you call growth, and these are stocks that earnings are increasing at a faster rate than the industry average. They're usually in fast and new growing industries and have the potential to give shareholders returns that are greater than those offered by the stocks of individual companies in older, more established industries. Growth stocks are the most volatile class. They have more movement. They have just as good a likelihood as going up as going down. Then we have value, and that price is driven by the cash flow and the underlying business. They're good earnings, growth potential, but they're selling below the price relative to their underlying value. So you have growth value, and then there is core, which is a blend of using a little bit of both. We'll talk a little bit more about this as we move forward. Then there is equities, and they're broken down by business line. Okay, so you have basic consumer, consumer cyclicals, financial services, real estate, consumer defensive, healthcare, utilities, communication, energy, industrial technology. Defensive meaning that they don't respond, they don't have as much growth potential, but at the same time, their downside is less. For example, toilet paper. So toilet paper would be a consumer defensive. Okay, people are still going to need that. Consumer cyclical may include restaurants, it may include car manufacturers. So there's going to be different factors influencing these. If we actually take a look at the returns, again, you see the same thing. That we see the results are different and they vary. So sometimes one's at the top, utilities were up in 11, bottom here. So we do see that. You can also look at them, the next piece you can look at them is by industry. Different industries have different results. And that you can check. Variation is caused by different economic expectations for each one. One of the things you're going to keep here, past performance is not a guarantee of future results. Equities. Let's keep going with that. Stocks have risk. They can move up and down. The price of stock is driven by the market, whatever the market thinks. And longer term, it's based on expected return of the firm, the earnings. What's the cash flow that's going to be thrown off by the company? So if a company is expected to do well and generate a lot of cash, you would expect the price to continuing to move forward. Now that includes the impact of macro events. If the price of oil drops, like it did, we could see oil companies hurt. Or you could see companies that utilize oil and gas, their prices, costs going down, so it could be better. Then there's actions of the firm, management, products, processes, innovation. What's going on at the company? What are they doing right? What are they doing wrong? What's a local thing that's impacting them? This is constantly being monitored by investors and analysts and traders who support these firms and look at them and know everything that's going on. They sometimes know more than the firm itself. The value, though, of a firm is essentially driven over time by the cash flow. And that really becomes important as your long-term investor is ensuring that the cash flow is there. Long-term, by the way, doesn't mean you buy and hold forever. It means being smart about it, but having a buy and a sell point. From different points of view, the market is very funky because at times you have short-term versus long-term. And right now, traders and corporate America is primarily focused on quarterly results. What happened this quarter? What happened today? Not what has happened over time, what it looks like, but that one quarter. And you got to be cautious of that on a long-term basis, looking for trends. And equity markets focus on short-term results and news. Let's now take a look at what a bond is.
You probably know investors use bonds to add income and diversification to their portfolios. But what exactly are they? A bond is a security that represents an agreement to repay borrowed money. Bonds typically have the following characteristics. An issuer. This is the entity that has borrowed the money. Issuers include the United States government, states and municipalities, and corporations. Principal. This is the amount of money borrowed by the issuer. Because issuers may borrow hundreds of millions of dollars at a time, the principal is divided into units, each called a bond. Bonds are typically issued in units of $1,000 each. Maturity date. This is the date when the issuer must repay the principal to the bondholder. Maturities usually range from several months to as many as 30 years. Interest rate or coupon rate. As with any loan, the issuer pays interest on the borrowed money. The rate of interest paid by the issuer is usually determined at the time the bonds are issued. The rate of interest you'll earn depends on the price you pay for the bond when you buy it. Let's look at an example. If a company issues a $1,000 bond with an interest payment of 5%, the company will pay the bondholder $50 per year. At maturity, you would be paid the entire $1,000. When choosing a bond, credit ratings are an important consideration. Businesses with lower credit ratings are generally considered riskier and must pay more interest to attract buyers. Therefore, lower-rated bonds pay higher interest rates. Buying a variety of bonds across interest rates and risk profiles can help keep your bond portfolio diversified. Bonds are generally considered a safer investment than stock of the same issuer. Just a small allocation to fixed income can help you diversify and significantly reduce volatility in your portfolio. Also, keep tax implications in mind. Many government-issued bonds pay interest-free from federal or state income taxes.
Okay, that gives you a basic overview of what a bond or fixed income is. When we look at them, we look at them by maturity. Short term is less than 5 years, medium term 5 to 10, long term greater than 10. So when we're looking at these maturities, we're trying to put them in these categories, okay? Because they're performing as a group, and this can help you evaluate the risk and the reward potential. One of the things that was said in there is, how does a bond perform under changing prices? Now, if you look, this is say a bond issued for 1,000, 4% interest rate at par. So as long as the interest rates are at 4% for that, it's going to stay at the par value. However, if market interest rates were to go down, that bond is still paying 4%, so that would mean that there is an increase in the price of the bond, a premium, so that it returns a 2% rate. And we can see the same thing here, that is, if rates go up, that investor who buys that bond still needs to get a market rate of return. In this case, it's 6%. But if you hold the bond to maturity, you have no gain or loss, and you will continue to get that. Now, we looked at this price behavior for a second here, and I'd like to introduce something that was not in the video, and that is duration. Okay, it's not maturity, and what this figure called duration does is it rolls up several bond characteristics into one number, primarily the maturity and the interest rate or coupon that is paid. And it indicates how sensitive a bond's price is to interest rate changes. So short duration is less sensitive than with one with high duration. So if rates were to change by 1%, a bond with a 5-year duration would lose about 5% of its value. And if it went down by 1%, it would pick up about 5%. So that's a brief review of bonds. Okay, we've now looked at equities and bonds. You're not just looking at picking stocks or bonds, but you're looking at a portfolio. Your entire retirement assets or your savings assets, or what your goals are, is a portfolio. It is a mix of different asset types. You need to develop a strategy or approach to managing it. That may include identifying your goal clearly. How will you know if you're successful? What are the measurements around success? What criteria will you use to select an investment? When will you sell an investment? You need a criteria to buy, and you need to know when to sell. You can't just trade stocks or play with them. That simply does not work. you can have a longer term portfolio, which is an investor. Remember the difference. Investor, long term, higher risk, higher reward. Medium term, you're more looking at average risk, average return. Short term, lower risk, lower return. So depending on your goals. So when you're going to build this, you need to take into account that every asset has a level of risk. One asset and your risk is too concentrated. Reduce the risk of volatility is achieved by diversification, as we talked about. And diversification is the active and variety of assets, not just one or two similar ones. A diversified portfolio has less risk. Each holding may perform differently. This chart here is really an academic one, and what it really shows is that when you look at portfolio performance over time, 91% of a performance, 92, it's between 92 and 96, is based on how you allocate your portfolio. Allocate it to stocks, and then breaking that down into foreign and domestic, small, medium, large, by investment style, growth, or value, and by sectors. So that is really the biggest results. When you look at stock selection, which is second, is only 4.6. Okay, market timing, minimal, and then other factors. So these are the factors, and this is why we're spending so much time on this asset allocation discussion, is because it's one of the biggest drivers of performance. So when we're looking at that, it's about how do we mix them together opposite your financial goals, the time you have to invest. You have 30 plus, I have maybe 10. And you have different risk tolerance. You have done your analysis, your suggested broad portfolio. I've done mine. Okay, so once you do that, you then identify subclasses and then allocate a percentage of your investment dollars into each class. And I'm just going to walk through and show you a couple of different portfolios that are there. And this is as of 4/1/14. I haven't updated it. But if we look at a portfolio here, aggressive, we can see those that have a 20% large cap, 20% medium, 20, 20, 10, 10. Over time has a return over 10 years of 8.3. 5 years, we've really been an exceptional market. So that you can actually see over time that a more aggressive portfolio over a 10-year period produces more than a moderate or conservative. And when we look at it at 5 years, they're almost even right now, and 1 year. So these are just the mix of the different sizes, international. We can take a look at the next one. It's very similar, a conservative, modeling, aggressive, and you're going to find there's different strategies. There's no one perfect one. Okay? Now, are you confused yet? Okay. You might be. So go back and listen again. It may seem overwhelming, and at times it is. And what it comes down to is most individuals don't have the time or knowledge to trade individual stocks. Okay? And if they do, they may not have a large enough portfolio to get true diversification that we talked about. And many of us have our retirement money in IRAs, 401ks, that are managed either by the employer or they're set up within a brokerage firm or a bank. So if you're confused, you're like many, but you also want to minimize not being diversified. If you buy one stock because you only got $5,000, well, then you have all your eggs in one basket. Now, to address this, about 40 years ago, mutual funds were developed to address this issue. And if we look at a basic mutual fund structure, basically a mutual fund, they bring together these, you can see this, these individuals. They purchase shares in the mutual fund. The mutual fund entity puts that money together, and then they have a set of professional money managers who select and purchase securities. And they end up with a diversified portfolio. You own a portion you are invested with that mutual fund and you have a share in all of these diversified assets. This, for many people, for many years, has given them entree into the equity markets. It's helped them stay diversified, which is an important thing, and participate. So let's keep going. These are big things. There's actually thousands of them out there. They're bought and sold daily based on the value of the underlying securities at the end of the day. So you buy them, but you're not going to know what the price you're going to pay is until you know what the underlying portfolio has done for the day. That's a disadvantage. You may have an idea what it's going to price at, but you don't always know. Mutual funds have the ability to grow the fund as it took in more investors. The major providers are Vanguard, T. Rowe Price, Fidelity, Schwab, etc. And there's thousands of these mutual funds. Okay, just thousands of them. And that is, how do you select them? Well, a couple of things. Let's stop and look at, no discussion of mutual funds would be complete without costs. Okay, and costs reduce your return. The first one is sometimes there are commissions or loads paid on the sale of that mutual fund. It's either on the front end or the back end. So you could end up with less money going in. So you might have a 5% upfront load, you put in $1,000, that would end up with $950 being invested. So you'd have to make up that $50. No load funds do not charge a sales fund. In today's day and age, nobody. Why would you pay a fee to buy a fund? There's so many out there. Vanguard, T. Rowe Price, all of them with no loads, no sales commissions. And honestly, there's no performance difference. If we took and looked at the funds that charge loads or commissions, there's no performance difference except for that fee, that sales fee. We then have what's called 12B1 fees, and these are fees for the marketing of the firm. So the firm has to sell these funds to keep things going, and that's a fee that the fund pays for. Then there's management fees. The way it's structured is the mutual fund hires an advisor to manage the fund because it's a legal entity, it's a trust. And then the advisor manages it, they get a management fee. Then there's transaction fees. This is every time you buy or sell a stock or a security or a bond, there's a fee, a brokerage fee. Then there's accounting and legal fees. When we look at this, costs really make a difference. And you have to look at mutual funds on a cost basis. Now, when there's so many to pick at, Morningstar really is the best place to go to sort through these. Morningstar, what they do is they are a research company. They do not sell mutual funds, but what they do is provide analysis to individual investors. Hopefully you've signed up for your free subscription. And what they have done is they have come up with a star rating. And what they've done is assign stars a rating from 1 star to 5. And as you can see here, that it's almost a normal distribution. So you have, here's a low 1, 10%, 10%, 5, and you have a normal distribution here. So basically, they're rated for up to 3 periods. They're rated on the past 3 years, 5, and 10 years. Okay, so that gives you a real sense of the method. This is how Morningstar sees them. Not that past performance is an indication or guarantee of future performance. Important statistics that help you evaluate mutual funds. The first is we call beta, and that's a quantitative statistical measurement of the volatility of a given mutual fund. But it's in relative relationship to the market. So it looks at the movement of that stock price relative to the S&P 500 over a period of time. Generally it's 5 years, and they look as to how it moves relative to the S&P. So if a fund or a stock has a beta or 1 it's more or less volatile as the whole market. If it's above 1, say it's 3, that is much more volatile than the market as a whole. So if it's less than 1, if it's less than 1, it's less volatile. So if you're looking at a fund and you're not really comfortable with a lot of volatility, you want to look for a lower beta. Okay? And if you want more volatility, you would go more. And that may be more from a trading perspective, but this gives you an idea of the volatility. It's a measurement of the volatility. The next thing that funds use is alpha. And that's a measure of the performance of the fund that's risk adjusted. So that's the difference between actual performance and the expected performance given its level of risk, or beta. Okay? If an alpha of 1 means it outperformed its benchmark by 1%. If it's less than 1, it underperformed the benchmark. So you're always trying to have an appropriate, you want a fund that is going to create alpha, in other words, be compensated for the risk that you are taking, given the beta, or the volatility. So there's the beta, the alpha, and the last one is standard deviation. And hopefully everybody's taking a statistics course and you have an understanding of what that is, and that's a dispersion around the mean. The more spread out the data, the higher the variation. In stocks, it's known as the historical volatility based on its annual return. So if we're looking at a standard deviation of 10, that means it performs over a period of time plus or minus 10% if the standard deviation is 10. So if the performance is 20 and the standard deviation is 10%, then you would find that that would be plus 2 to minus 2. So it's more of a measurement of the volatility around that. Now let's take a look at Morningstar. Now we're looking at the home screen of Morningstar, and as you can see, there's a lot of different categories up the top. And what I'd like to do is take you to the category called funds, because we're looking at mutual funds. When we get to mutual funds, there's a few things that'll be there. One, they will talk about what are the top things going on in mutual funds right now. You're going to find some past articles, things about investing. It's also going to have a featured fund, which will tell us about one specific fund. It'll take a look at fund families, and these are the asset managers, and American Funds has a lot of different funds. And you're also going to have a lot of ratings that you can go in and look at the ratings. You can do a performance, you can screen, you can look at analyst report on them. So what we're going to do is what we want to do is we're going to go in and look at a basic fund screener. So I'm going to click on this. It's not the fastest one in the world. And what it does is it's asking you to set criteria. So what you're going to do is you have what's your fund group. Okay, so this is your broad one. If you want U.S. equity, we'd click on that. And let's look at Morningstar category, and let's put in a large. So I'm going to put in here U.S. equity, because that's what I'm looking for. See all the different categories. Each one is in sectors. Let's say I want to go with large growth. I want somebody that's been around for 10 years, a manager. I can put anything in. Minimum investment purchase. Well, if you put 10, you need at least 10. Any if they need 100. So I just put in 2,000. I don't want to pay any commission, so it's no loads. And I want low expenses, and I want them to be highly rated. So when you're on this search page, you enter the criteria, and you can refine it based here on others. And you press show results, and let's see what we got. We don't really have a lot of stock or mutual funds that are rated 5-star, expenses less than 1%. The manager has been around for 10 years or more and has that expense. So the first one I'm going to click at is this one here. And what we see is here's the current price. This is the change from yesterday. Yesterday was a good day in the market. This is the yield. This is how much is paid out in dividends. So there's some dividend paying stocks here. It It's in the category called large growth. They have $15.8 billion in assets, expenses of 0.52, and that's telling us it's below average. So here we look at what's happened over 10 years. We tend to see that it's following the market. What we look at is a couple of more things. Let's go over to ratings and risk. Okay, what we can tell here, if we use the 5-year, is the return is above average, the risk is average. But if we go 3, 5, and 10, we can see it's high, above, and high. So what we can see is it's got a consistent rating over time. That means it's consistently performed in the top. But remember, past performance is no guarantee of future. When we look down and look at some of the statistics, we can see a couple of things. The first is the 3-year trailing return. So what you can see, they're comparing it to the Russell 3000. That's the index. And as you can see, the beta, it doesn't move as much as the S&P. S&P is 1. But the alpha is 322. So that's telling you you're being well rewarded for the risk that you're taking. If we click on 5 years, we can see that the beta is almost equal and the alpha is minus, but in the category, when we're looking at others, it's worse. So they're beating the competition. We go out 10 years, and again, we see it's pretty much in line with the market, but it's creating a higher return. These others are meaningful, but we're not going to focus on them at this point. So when we look at the volatility, we can see that the standard deviation is 10.23 relative to 1909. So that means it could be 29 and it could be 9. So there's variation within that. When we go back up, we can take a look at the portfolio, and we can see right now that they're just 59% in the U.S. Non-U.S. outside is 30. They have a little bit of other and a little bit of cash. But we can see that it is diversified between foreign and domestic. Let's take a look here on the sizes, and this gives us the number here, sizes of the investments, the company size. But what we can really see is it's all pretty much large, good piece of medium, but giant and large. Morningstar uses giant and large in this thing, but they really, from an academic perspective and what most people look at, we just say large, medium, or small. So it's got a blend of both. So, and if you can look here, you can see that the style has been fairly consistent. If we go down, we can see what sectors they're involved in. You can see they're in consumer cyclicals, financial services, energy, industrials, technology, still fairly high. This is the benchmark, the S&P 500, and this is what the percentages of theirs. Healthcare, they're overweighted in healthcare. They're underweighted in industrials, underweighted in consumer defensive. So it will behave differently. Then if we look, 68% of the stocks are in Americas, 14% in Europe, 17% in Asia. And within that, this is where it is broken down. So developed markets, about 90, emerging markets, about 9. So what can we conclude about this fund? One is that it has a blend of foreign and domestic, that it has a blend of sizes, although almost 60% is large and giant, but there's some medium here. We can see that it is spread out amongst the sectors. It's a heavier weight in healthcare and underweighting in consumer defensives and industrials. We can see that it's spread out around the world. So we come back to the performance again. We looked at the ratings and risks, and we look at the performance. We can see that the return over time has been significantly better than the market as a whole. Not consistency, but it's generally there. Okay. Last year they didn't do as well. Okay. This year they're doing real well. See this 487? Okay. 1369 didn't do as well. 4382 they beat it. They beat it. Ooh, they really got it there the wrong way. So you can see that the results are inconsistent, but over time they have been good. And we go back to the quote, and we see that the American Fund's New Economy looks like a pretty good fund to look at. Now, let's go back. These are the 9 that met my criteria. So I would look at some of these and say, which one do I want to get involved with? And that's where you start nailing it down. Once you start getting that you have, I want so much in large, then you go look at this. You want so much in medium. And you set some of the criteria to get what you think is the very best.